This episode of Talk Your Book is proudly brought to you by Stock Doctor.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Rob Frost, thanks very much for coming on Talk Your Book. I know you're incredibly busy, so wrapped to get you on. Why don't you start with telling us a little bit about OC Funds Management and what you guys look to invest in?
Sure. OC is a Melbourne-based boutique fund manager. We've been in business for almost 19 years now. We focus predominantly on the Australian small to micro cap space. We've got about $1 billion under management now. Funds have performed pretty well over the last 10 years. The small cap products have returned around 13 to 14% per annum, and the micro about 13.5% versus their benchmark, which are around 4.5%, 5%. We like to be seen as a safe pair of hands and have a pretty heavy focus on risk management.
That's good. And what stock do you want to talk about today?
I guess now you've hung the footy boots up and you've got 4 kids at home, I thought I'd focus on a business that you might know something about, namely Baby Bunting. They're Australia's largest specialty retailer of baby goods with about 55 stores around the country.
And talk about their company's history. When did they list and what's their background?
Sure. So Baby Bunting actually started nearly 40 years ago as a single store out in Balwyn. Back in about 2006, a consortium of high net wealth private investors, including Barry Saunders, who used to run Reject Shop back when it was a really successful business, came on board and put some money in. They put some capital in and expanded it. And then in about 2012, TDM Asset Management, who's a big Sydney-based fund, put a big investment in to help grow the business, and it expanded into online and interstate. And then it listed on the ASX back in 2015 at about $1.60 a share, which is when we became investors.
And what are the financial metrics of Baby Bunting that you like at the minute?
We think it's got huge potential for margin expansion across the business. Management sort of talked to a long-term EBITDA margin of 10%. It's trading at about 7.5%. So, that's 33% EBITDA upside in itself. They've still got large leverage off their platform. They're at 55 stores. They can go to at least 80. Their private label, own brand products are now about 33% of their sales. They think they can get that to 50%. And by way of example, private label, we think they get about 10 to 15% more at a gross margin level. So just leverage off scale and getting their cost of doing business down. And they don't have a lot of competition left in that specialty goods space these days.
And so they've got 2 distribution channels, the bricks and mortar stores or the online channel.
Yes.
They're committing to a pretty aggressive store rollout now. What do the economics look like of their store rollout strategy?
Sure. So they're at 55 stores. They say they can get to 80, although they're doing a network plan at the moment with the group. They've got a big group called Deep End Solutions doing a network plan, and we think they can probably take it beyond 80. So they talk about 4 to 8 stores a year. Costs them about $600,000 to do their large format stores, about 1.5 in capex. Then they've got inventory, call it large format, another 600,000. Year one, they tend to do around 4.5 million sales and about $300,000 in EBITDA, and it ramps up over a 4-year period to around 7.5 or 7.8 mil on average revenue and about 1.2 mil in EBITDA. So, it ramps up over 4 years and becomes quite a profitable business for them.
And they're originally more of a big store format. They've started rolling out at shopping centres as well. How's that going, and is that significant for the company going forward?
Yeah, it's really early days, but when Babies R Us, Toys R Us went out of business, they picked up a couple of their sites. So Chadstone was the first one, so biggest shopping mall in the Southern Hemisphere. I mean, they spent about 1.6 mil fitting that out versus 600 in their traditional stores. It's gone very well for them, albeit early days. So I think the most recent data we saw, they're doing about 35% more volume than their top 10 Main Street stores. So it's easily their biggest store now.
It feels like a category where having a bricks and mortar presence is important. Obviously, mums and dads to be want to go in there and I guess build a certain level of trust in the products they're going to buy. Do you feel that insulates them a little bit from really aggressive online rivals coming into the market?
Yeah, it's interesting. I guess, we've got a 1 and 2-year-old, and the wife loves to go in there and chat to someone who's an expert in the area. People, when they have kids, want to make sure they're doing the right thing and buying the best that they possibly can. So Some customers spend up to 2 hours with the sales staff, just, getting to know the products and understanding the category. So I think it definitely insulates you. Also, the other thing is Australian safety standards are very, very rigorous in baby goods. So that's a massive barrier to entry from some of the online players offshore. So you've got mandatory safety standards that are monitored by the ACCC. So take, for instance, Amazon can't just, leverage their large offshore buying power and bring in a bunch of prams, because if you look at the Australian pram, it's got a red brake. It has to have a red brake, red label brake, surrounded by a contrasting colour, whereas offshore, sometimes they're white or they're different colours. So they can't just bring a whole lot of cheap prams offshore and bring them into Australia.
And some of the competitors have fallen on hard times and actually gone out of business recently. How's that affected Baby Bunting currently, and what effect do you see that happening in the future?
Yeah, it's been a bit of a tumultuous ride recently, the share price of Baby Bunting. They had their 4 biggest national competitors all go broke within the space of 12, 18 months.
Yeah. And why was that?
Just a lot of competition. It's a very tough space. Baby Bunting are very good at what they do, but you had Babies R Us, Toys R Us go out of business. You had Baby Bounce. So about $140 million worth of goods left the industry. So that we saw that as a big opportunity for Baby Bunting, albeit over that period there was a lot of stock liquidations. People could buy baby goods cheap for the receivers when they were liquidating stock. So that had a real impact on Baby Bunting. So it was one of those ones where we looked at it and thought, this is a structural issue and they should get through it and be a stronger business. So it looks like they're capturing about 30% of that $140 million worth that's left the industry. So, that's a really strong reason why we've stayed in the stock and why it's been growing so strongly in the last couple of years. Their largest competitors now, national competitors, only got 3 stores.
Wow. And they're moving into services through installation of car seats. Could you see other services they could grow into, and could that become material, or at this stage is it just a small part of the business that you're not paying a heap of attention to?
Yeah, it's a small part of the business. I guess, they've still got a fair way to go on their domestic rollout, and they're not targeting offshore. It really just gives them a differentiator from their online competitors, shows their focus on safety, it gets the brand front of mind. They want to use that platform that they've got to go into baby seat hire, capsule hire, potentially other verticals like breast pumps, which is a high big ticket item, lots of consumables. So get into that higher space, maybe even prams. I think they're going gently at the moment, but they're thinking bigger picture and longer term.
And they've got a real focus on private label products to increase their gross margin.
Yeah.
What sort of percentage do you see them potentially getting to with private label products? 3
or 4 years ago, they told us they could get to 35%. We were a little bit sceptical. They went from 17 to about 27 at the end of financial year 19. At the AGM the other day, they said they're already up to 33. So they're moving very quickly towards that 35%, and they've upgraded that target to 50%. Now that they're the biggest national player by a long way, they've got a lot of leverage with their suppliers. So they do a lot of exclusive branded products, prams, cots, that sort of stuff. So we can see them getting to 50% pretty comfortably, which is, again, a barrier to entry and should see their margins increase quite a bit.
They've got a lot of similarities to Bunnings, don't you think, in terms of exclusive rights to products, private label offerings, sort of really owning and dominating that space? Do you sort of see similarities between the two?
Yeah, and that's one of the things that attracted us to it. We see it as, you look at Bunnings and they're the category killer in hardware, and you think of Officeworks, Dan Murphy's maybe, JB Hi-Fi. Baby Bunting's certainly heading in that direction in terms of baby wear. Absolute dominant player and big barriers to entry and generating a good competitive moat around their business, which is something we really like.
If you are the category killer, I guess there's going to be a time when they've rolled out 80 stores where they stop being viewed as a growth company.
Yeah.
Does that still keep your multiple up because you've got opportunities for margin expansion elsewhere in the business?
Yeah, I mean, that's the perennial challenge, isn't it? At that point, the business will generate a lot of cash.
Yeah.
And I guess they'll start looking at other vertical expansions such as B2B, which is an area they're not in. The big childcare centres like G8 Education purchase $4 or $5 million worth of baby goods every year. Car companies who need car seats, there's restaurants, that sort of stuff. So they might go into the B2B space, but always hard to maintain that multiple once the growth trajectory tapers off.
Bunnings has the Saturday morning sausage sizzle. Did you see the Saturday morning acai bowls at Baby Bunting? Or what can they do there?
Breakfast cereal.
What about risks? What are the risks you see for the business? Or what are you keeping a lookout for to say, if this happens, then we'll have to review our position? Online's
always a perennial risk. Amazon came into the space, for instance. They opened up in Australia in December 2017. And the market perceived it as very bad for Baby Bunting. You look at the stock price graph. But, I mean, I guess 75% of the stuff at Baby Bunting, Amazon doesn't sell. And of the 25% they sell, I think Amazon's only cheaper on 7 or 8%. But, at some point, they're going to get bigger out here. They're going to get more purchasing power. So certainly the threat of online's one of the major risks we see. There's always execution risk. I mean, in any sort of rollout, they're doing 4 to 8 stores a year. So they've been able to do that very well to date and haven't needed to raise capital. But, they're moving into new formats like shopping centres. They've just started up in regional areas, which is a bit of an unproven model, albeit, the early signs are good. So there's always risks involved in that. So that we're always trying to stay on top of how they're performing.
What's their balance sheet look like? Can they commit to this store rollout without needing to raise equity?
Yeah, well, I mean, that's one of the things we love about it, a business that can roll out stores and not have to come back to the capital markets, because it means we don't get diluted. But at the moment, I think they've got about $2 or $3 million on their balance sheet, which is enough to fund the rollout. It's quite a cash generative model. If they wish to accelerate it, which I don't think that's in their plans or the ones that I'm aware of, they might need to come back to the market. But it is a model that could take on a little bit of debt, but the management are very conservative. So, I don't think they'll take on too much debt, and they should be able to fund their rollout.
Well, Rob Frost, you're a guest on Master of the Market. Very glad you managed to make it onto Talkie Book. Always great to catch up.
Thanks, Chris. Thanks very much.
Thanks, Mark.
Cheers.
If you're interested in building your own investment process, make sure you check out Stock Doctor, the proud partner of Talkie Book.